financial statements are one of our most important sources of information in finance. So while on the one hand, I'm not trying to turn this into an accounting class, and won't turn it into an accounting class, because I'm not going to be doing debit credits and all that. One of the things that I am going to be doing is making sure that you understand the basics of financial statements. So if there's any holes, you know, everybody's had different instructors for different courses. Okay, and some of you aren't even from UCF. This might be your first time at UCF. So we probably have holes here and there, so I want to make sure those holes are filled in. Yesterday we were talking about cash versus accrual accounting. How many financial statements are there? Okay, 4, very good. Those are, of course, balance sheet, income statement, statement of cash flow, and statement of shareholders' equity, which is often included in the balance sheet if it's not too sophisticated. Okay, so you'll hear me refer to 3 statements, but actually there are 4 statements. See, what else did we talk about yesterday? Accrual versus cash. We talked about earnings management. Okay, earnings management I think is a very important topic for you guys because I hear it referred to sometimes as if it's a legitimate practice. Okay, and it's not. All right? It may be widespread, but it is not a legitimate practice. And I shouldn't have to convince any of you guys that, because you guys know that earnings per share, I mean, investors, we all live and die by earnings per share. If you're an investor, you're entirely glued to earnings per share information. If you're a CFO, we talked about yesterday about missing analyst expectations and all of that. Those earnings per share are a result of generally accepted accounting principles, which are a result of these estimates that I alluded to yesterday. Okay, so if for no other reason than that, the more you understand about how these things are put together, the better off you will be. Okay, so we talked about that. We talked about the fact that financial statements generally are generally recorded at historical cost. So that becomes important. For example, I'm sure somewhere along the line, you guys ran across the importance of the market-to-book ratio. Okay, what's the importance of that ratio? I mean, there could be lots of answers to that question, but I'm thinking of one in particular. The market-to-book ratio. Yeah.
I think maybe it's overpriced or underpriced company.
Okay, very good. That's a measure of the company's value. Okay, so we're looking at the trading price, basically, depending on whether it's per share or in total. We're looking at the trading price versus the book value of the company. The intent being, well, of course, the higher this ratio, the more overvalued we would argue the company to be. But, given that we're talking about book value, what does this book value generally represent? Historical cost.
Yes.
And I gave you one example yesterday of where that may not reflect value. Because in normal economies, real estate prices tend to increase. Well, we're looking at building on the balance sheet, and it's showing what they paid for the building, net of depreciation. Okay, so we have that potential issue there. What are some exceptions to historical cost accounting? And this is McDonald's balance sheet. I understand it's kind of small, but it has nothing to do in terms of zooming in on it. What are some exceptions or potential exceptions to historical cost accounting? There's the assets. Okay. Would there be anything in here on here potentially carried at fair market value? Even under today's GAAP. Okay. Inventory. First of all, recall that inventory is carried at lower of cost or market. Okay, so McDonald's, for example, has $121.7 million in inventory. On the surface, we would say, well, that's what they paid for their inventory, but that's not necessarily the case if the market price of their inventory dropped below that. Now, this is not a manufacturing business, so whether or not, that sounds kind of unlikely to me, all right, how the price of Big Mac sauce drops below the cost of Big Mac sauce. I don't know how you do that, okay? But in a manufacturing environment, that might be a little more realistic. Also, understand that this inventory, even if it is carried at cost, how's that cost determined? Let's say we're comparing McDonald's to Wendy's. Okay, and we're looking at their inventory. We're interested in their inventory turnover ratio. What is something that we would want to pay attention to, even if they're both carried at cost? FIFO, LIFO, average cost. All three of which are valid. So if you're looking at McDonald's, who carries their inventory at FIFO, and Wendy's, which carries their inventory at LIFO, let's just say, you're not comparing apples to apples. Necessarily. Sir?
Don't they normally state that they're?
Yeah, in the notes to the statement, yeah.
Yeah.
So that's one of the things that you're going to want to go look at. If you're, like I say, inventory turnover ratio, for example. If you're analyzing their inventory to try and make a determination of which one is moving inventory better, okay, well, then just looking at 121 versus whatever Wendy's has, for example, isn't rigorous, isn't complete. Because we're, to be prudent, we're going to want to go see how they're carrying their inventory. Right? If one, let's say McDonald's is at FIFO, Wendy's is LIFO, all of the things being equal, what effect is that going to have on earnings per share? And I'm saying all of the things being equal. Let me rephrase that. What effect could that have on earnings per share? What would you expect? Okay, what? Exactly. Exactly. So with Wendy, the last in, first out, okay, that would, what, decrease earnings? Assuming inventory prices are rising. Okay, so all of the things being equal, we would expect Wendy's earnings to be lower than McDonald's just because of an accounting choice that they made. Okay. That could also play into earnings per share. Now you guys know, I hope you know, you can't just change your inventory methods every year. Okay? But occasionally you can. Okay, as long as you can justify it. Well, maybe we're interested in doing some sort of earnings management thing like we were talking about yesterday. We haven't changed our inventory method in 10, 11, 12 years. Might be a good time to hit that well. Okay? Okay, what else might not be carried at historical cost? I'm thinking of one thing in particular.
Appreciation?
When would property, plant, and equipment not be carried at cost? I think we identified our other accounting measure. When might that not be carried at historical cost? Okay. Yeah, probably not just because the market crashed, but if some sort of natural disaster happened. McDonald's probably isn't a great example of this because they have them all over the place, but if some sort of natural disaster happened, here in Florida, a hurricane comes through and takes out a third of the building, and we have a permanent impairment. In fact, on McDonald's statements, when we get to the income statement, they have impairment on there. Okay? So that's where we would permanently write something down. Okay? So you're correct about that. What I was thinking about was investments. Okay, maybe not necessarily in affiliates, as they're saying here, but if you have marketable, if your company owns marketable securities, are marketable securities carried on the financials at historical cost? No, they're carried at fair market value. Why are they carried at fair market value, finance majors? One of the things, a couple of years ago, looking past all the details, a couple of years ago, I had to teach graduate level auditing on the merger. It was like 2 weeks before the semester started. Things had happened up there. They didn't have anybody to teach it. So they pulled me over, and I hadn't thought about auditing in a long time, and very hard prep. But anyhow, I went and taught that class, and it was very interesting to me because when I first started my career as an auditor, we were doing all of these things, real world. I mean, going out and actually really doing it. We were going out and following the audit program and doing all these things. And frankly, some of the stuff we did, I had the slightest idea why we did it. Okay? The audit program says do it. I did do it. I did it correctly. I had no idea why. But going back after all these years with all the finance training and looking at the standards for why you do this and why you do that was actually very interesting. Okay? Because underlying those accounting rules are finance theory. It was interesting, it was fascinating. I would love to own the course and taught it some more, but in finance and accounting. Why are marketable securities carried at fair market value and not historical costs like most everything else, such as property, plant, and equipment? Okay, because they are highly liquid. They're highly, and therefore their values are much more certain. Okay, we talked about that yesterday. That's why we do the historical cost of property, plant, and equipment, for example, in the first place. Okay, you get 10 appraisers out there, you get 10 different answers. But if you own IBM stock in this company as an investment, and you need to know what the value of IBM stock was as of December 31st, 2012, that is relatively easy to determine. You go look at the closing price, and that's it. Okay? Now, while we're on the subject, what is liquidity? How do we define liquidity? And if you have me for 3403, no fair answer. Until everybody else has had a chance. How do we define liquidity? Outstanding. The speed and ease with which we can convert an asset to cash without a significant loss in value. And that's why I'm reminding you of that definition, because we tend to forget the without a significant loss in value part of that. Okay? What we tend to say is liquidity is just if we can convert something to cash quickly, then it's liquid. Okay? But that's not true. The example I always use in 34.3 is the car I have out in the parking lot. Could I convert that to cash quickly and easily right now? Sure I could. How? Sell it for what? Yeah. If I sold it for $5, anybody in here who had $5 on them would be willing to buy that car, even if it's the biggest piece of junk that's ever driven on the streets of Central Florida. Because you can pull one tire off it and sell it and make that. Okay? That doesn't make my car liquid. Okay? So the speed and ease with which we can convert an asset to cash without a significant loss in value. Okay? Great. All right. What order are things listed on the balance sheet? Order of liquidity. Okay, so I just pulled up McDonald's, and this was semi-random. It's just a company that I'm a little bit familiar with, but I haven't gone through all their notes and all the stuff on the financials. So let's take a look briefly through their financials to make sure we have a grip on the basics, and then we'll go through a fictitious set of financials so you can see what's expected of you on the exam, and really in real life as well. By the way, almost every year after I teach this course, a month or 2 or 3 will go by, and I'll have 1 or 2 students email me, and they'll say, you know, I really appreciate your models course because I just got a job and we're doing the exact same spreadsheet that we did in models. And I always email back and I said, great, thanks for letting me know. What is it that you're doing? And I've yet to get an answer to that question. So if that applies to you guys, will you please tell me what you're doing so that I can be sure and recreate it in here? I mean, I do pretty much the same thing, so I think I'm getting it, but I haven't really got a good feel for what it is that they're actually doing out there. So anyhow, okay, so we've got, notice our assets, current assets, and longer term assets. What's the difference? Okay, yeah. Yeah, and notice, sorry to interrupt you. Notice that in your textbooks, what you usually see is current assets and fixed assets. Okay, but notice in real life, that's normally not how they're listed. They're normally listed current assets and then PP&E, property, plant, equipment, which is what you can expect on the exam. What's the difference between current and the long-term assets? Yeah, current assets are assets we expect to be converted into cash within 1 year. Actually, it's 1 year or one operating cycle, but I'm not gonna get into that. I'm not gonna split that here with you. Basically, within 1 year, okay? Longer-term assets greater than a year, okay? So we got our current assets up top. We got cash and cash equivalents. What's an example of cash equivalents? What is a cash equivalent?
Bond.
What's that?
Bond.
I don't, well, perhaps.
Treasury?
Yeah, I would say treasury bills are probably a better example.
Yeah.
Certificates of deposit, so forth and so on. Things that can be converted into cash with a phone call, okay, without significant loss of value. I'm sorry?
Foreign currency?
No, I wouldn't say, I don't think foreign currency, because they have the translation down there. I'm not sure about that. I don't think foreign currency be cash equivalent because the value changes. So I don't think that one. And similar conversation with treasury bonds. Even though they're liquid, the value is very sensitive to, relative to T-bills, sensitive to the price change, or the yields. So I'm not sure those two would really be listed in there, but T-bills, certificates of deposit, those would certainly be listed in there. Okay. We got accounts and notes receivable. What's the difference? What's the difference between an account receivable and a note receivable?
McDonald's not going. Okay.
Okay, someone help me out. Yeah. Yeah, accounts receivable are the result of your customers. That's what your customers owe you. So accounts receivable arise in the ordinary course of business, as opposed to notes receivable, which are usually outside of your ordinary course of business. Okay? They have them grouped together here for presentation purposes, but that's generally the difference between those. Okay. Notice they have inventory listed at cost, not in excess of market, which is a long-winded way of saying lower of cost or market. So we talked about that. What's an example of a prepaid expense? What is a prepaid expense? Yeah, insurance is an example. A prepaid is an expense, is an expense that we have paid but we have not yet incurred. Remember from our accrual definition yesterday? It's an expense that we have paid but not yet incurred. For example, insurance. Because you guys all know, if you don't, be advised, you pay for insurance ahead of time. So if you're looking for insurance coverage for the year 2013, you pay that at the beginning of 2013. So you paid the expense, but you haven't received the benefit of that expense yet. Okay? As 2013 goes on, what happens? Yeah, you take it out of prepaid expense and it lowers your earnings because you run it through expenses. Okay? Investments, we talked about goodwill. What is goodwill? Yeah.
When you buy a company for what it's worth.
Outstanding. Be careful with the part of that more than it's worth, but yeah, more in excess of their cost, if you will. Okay, so but I mean, I'm not going to split that here with you on the example, but really what I'm getting at here is that the only time you would see goodwill on here is when you've purchased another company. You don't record your own goodwill. Okay, so let's say someone in here starts a business, okay, that you pay $50,000 for it, and well, that you I'm gonna stay away from that. You guys gonna start this 15 years from now, your business is worth a heck of a lot more than what you paid for it. You wouldn't book goodwill on your own just because you built that up in there. Okay, so this only arises when you purchase another business. Okay. All right, so we got property and equipment at cost, accumulated depreciation and amortization. What is depreciation? And this is, go ahead. Okay, expensing the use of an asset. Anybody else? What's it? Loss in value. Okay. Okay. As finance people, okay, we're interested in value. So usually when we talk about, depreciation, what we're talking about is the loss of value. But on the financial statements, depreciation is not intended to estimate the decline in fair market value. What it does is it spreads the cost of an asset over the useful life of that asset. Remember your matching principle? Okay? Because you buy an asset that lasts for more than a year, you're going to be receiving benefits for many years from that asset, right? If you expense all of that asset in the first year, then your earnings would be very low, if not negative. But then the remaining years when you're receiving benefits, you're receiving all these benefits with no expenses. So your earnings are going to be higher, which does not properly reflect the underlying economic condition. Okay? So the purpose is to match the expenses with the benefits. Okay? That's the purpose. Now, it would arguably approximate, there would be a positive correlation between the book value of an asset and its fair market value. We would expect a positive correlation. Okay? But the intent isn't to try and peg fair market value. It's to spread the cost of an asset over the useful life of an asset. Okay? Everybody got that? Okay. And that's important because if we think that this is reflecting value, then we think that property, plant, and equipment is carried at fair market value. And it's not yet. I got on my IFRS soapbox yesterday, and I'll stay on that today. I'll try to stay on that today. Okay. What's the difference between depreciation and amortization? Okay. Depreciation is for tangible assets. Amortization is for intangible. The concept is the same. Okay, the method you use will probably be different. Okay, but the concept is the same. What's depletion? That's the one thing that's not listed here. Natural resources. Very good. Okay, so make sure that you can distinguish between depreciation, amortization, and depletion. And that's a pretty good example of basic balance sheet accounts. Question? Asset accounts. Okay. Accounts payable. What are those? What's the difference between, I don't see it on here, accounts payable, let's say that they had notes payable, just for the sake of argument. What's the difference between the two?
One that's a little more structured, it's got more like, more permanent, it's not as likely to not be paid.
Okay.
I think accounts payable is when you pay, when you own customers, I think.
Exactly.
Accounts payable is maybe like not your regular services, maybe contract payments or
Exactly.
something.
Yeah, it's the same conversation we just had with accounts receivable versus notes receivable. Okay? Accounts payable are going to arise in our ordinary course of business, what we would owe our suppliers. Notes payable would probably be something outside of our ordinary course of business. Okay. Income taxes. Income taxes, you got to be careful because when they, with corporations, what they do, I wish I had Nicole here, who's probably had a lot more experience with Ernst & Young in this than I have, but what they do here is they have what's called a tax accrual, and the upshot of it is what they're booking as a liability are the taxes that you would owe if you liquidated the business. So that's including like the capital gains and property, plant, equipment, and so forth and so on. Okay, so you got to be a little careful with income taxes, and remember that next time you hear people complain about the U.S. having the highest tax rates in the world, or second highest, or whatever it is. Honestly, I haven't really looked too closely at that, but this is definitely an area where the devil's in the details. Yeah, I said that same thing yesterday, didn't I? Yeah. Well, I got traumatized by the guys over there in IT that said Apple was the Apple was the devil. So that traumatized me, so I got that on my head. Okay. But my point here is be a little careful with income taxes because it's not as simple saying, oh, that's what they paid in taxes last year. Okay. It's not that simple. All right. Other taxes might be things such as, okay, a more complicated example than I was thinking, but yeah, real estate taxes, okay, tangible taxes, intangible taxes, all that kind of stuff. Okay, accrued interest would be, yeah, what are accrued expenses? What are accrued expenses? Because this is an example of an accrued expense. We talk about prepaid expenses, what are accrued expenses?
Expenses that have incurred that you owe.
Outstanding. Expenses that we have incurred but not yet paid. Okay. So we have McDonald's as of December 31st, 2012 owes some interest on their debt that they haven't paid yet. Okay. A more common example, at least for smaller businesses, accrued payroll. Okay. The end of the year falls in the middle of your payroll cycle. Okay, so maybe employees are due to be paid through January 8th, assuming they're paid every 2 weeks. Okay, the end of the year would fall right in the middle of that. So at the end of the year, employees are owed a certain amount of wages, and they have not yet been paid those accrued payroll. Okay. All right, so those your current liabilities, long-term debt. You know what that is. Other long-term deferred income taxes. This is the same thing that I was just talking about, and I skipped over a big one that you may or may not have encountered before, depending on exactly what classes you've taken. Current maturities of long-term debt. What is that, or at least what's an example of that? Yeah,
How much you owe on bonds
okay,
that are within 1 year?
yeah. The current maturities of long-term debt and the long-term debt go together. Okay, so for example, just for the sake of conversation, and where I've seen this most often is with mortgages. Okay, so just for the sake of conversation, let's say that this is a mortgage that we're talking about. Okay, that's the only long-term debt they have is one mortgage. These two entries are for the same debt. Okay, remember your amortization schedule? Okay. This is the portion that's coming due this year. This is the portion that's due in greater than a year. The same thing with holds for bonds. Okay? So these two entries right here, these two line items go together. All right? Okay, questions about that? All right, very good. Other long-term debt, deferred income tax, we talked about that. All right, shareholders' equity. We have preferred stock and common stock. Why is preferred stock listed first? Yeah, in a nutshell, because that's what's paid first. Okay, so again, we've got an order of liquidity. So think if this company goes into bankruptcy and everybody starts lining up for their share of assets. Okay, this is pretty much how they're going to be distributed. Okay, so preferred shareholders would get there first. Common stock and additional paid-in capital. Counting majors, no fair here. Take a break for a second. What's the difference? What are these two accounts? We've got common stock and additional paid-in capital. What is the difference between these two accounts? Just a reminder, this is real-world financial statement analysis.
Additional paid-in capital is the price over common stock that was paid,
Okay, the price over what?
the par value.
Outstanding. Okay, very good. You accounting major? I said no fair for accounting major. That, I'm just kidding. Okay, common stock and additional paid-in capital together represent what the investors have paid for the stock. Together, these two represent the total price of the stock, if you will. Keeping in mind that the stock, especially with McDonald's, has been sold at various prices over a long period of time. Okay? What's in the common stock account is the par value. Okay? So, let's say, to make things simple, you have a company that has a $1 par value. Okay, that when you do your articles of incorporation, all that, you just assign a $1 par. This has a 1 cent par value, probably because they've authorized more shares over the years and brought that par value down because it's been diluted, et cetera, et cetera. Okay, well, let's say you have $1 par common stock. Right? That doesn't necessarily mean that you're going to sell the stock for $1. Okay? In fact, with respect to common stock, the par value, as far as I've ever been able to determine, is pretty much an arbitrary amount. Okay? So let's say you're issuing $1 par value common stock, but you're going to issue it for $3. And you're issuing 1 million shares. Well, what that means is what would go into common stock is 1 million, and then the remainder over par value, 2 million, would go into additional paid-in capital. Okay? So that's what those two accounts are about right there. Later on, if you sell it for $5, sell another million for $5, then that would be 2 million in here, and you have another 4, and you have 6 in additional paid-in capital. And so forth and so on. Okay. All right, questions about that? Questions about that? The equity section is where it gets exciting. Next, retained earnings. Please tell me what retained earnings are. Please tell me what retained earnings are.
For the shareholders after dividends.
Okay, these are the earnings from the company after dividends as of when? Well, yeah, poorly put. Over what period of time? Since inception. Okay, so these are the profits that have been retained in the business after paying dividends. That's important because sometimes what we, and I've heard PhDs screw this up, not because they're stupid, but we start taking this stuff for granted. Okay? If you pay dividends, finance majors, dividend policy, when you pay dividends, from where do those dividends come? Don't say with cash. They come from retained earnings, which means if you don't have retained earnings, you can't pay dividends. Okay? McDonald's doesn't have to worry about that, but I've seen lots of small businesses get themselves in trouble over that. Okay? Because what happens is, you've got all these owners of a small business, and Ruth takes home, takes some sort of distribution earlier in the year, and they just throw it on the books, as a receivable or something, don't really know what to do with it. Well, the end of the year rolls around, okay? We still have this $5,000 or whatever it is sitting on the books, and the temptation is to say, let's just call it a dividend. And the reason they're doing that, one of the reasons they're doing that, is to get around payroll taxes. Because if she's an owner in the business and provides services in the business, whether you like it or not, she's an employee subject to payroll taxes. Well, this distribution was back in February. Okay? So they owed payroll taxes back in April, actually back in March on her, and didn't pay it. So they're saying, let's just take it as a dividend. A couple of problems with that. Number one, if you don't have retained earnings, you can't do that. I mean, you can make a distribution, but it's not a dividend. What's another problem with that? Dividend policy. What's another problem with that? Okay, these are all the owners, the front row is all the owners of the business, and they all own equal shares in the business.
They don't want you to pay the dividend.
Yeah, you can't just pay one a dividend. They're all entitled to their pro rata share of the dividend. So if you make a $5,000 distribution to Ruth, then everybody else, again, assuming they're equal shareholders, everybody else is entitled to their $5,000 on the level. Okay? If you don't do it, then it's not a dividend. And what the IRS is going to do, I'm telling you, what the IRS is going to do, they're going to say is wages, you owe payroll taxes, plus interest, plus penalties for the entire year. Okay? Yeah, well, yeah, that's, yeah, I mean, I've seen that as well. Questions about that? Okay, and then accumulated and other comprehensive income, I'm not gonna get real frisky with you on that, but I might get frisky with you on treasury stock. What is treasury stock? Yeah, it's the company buying back its own stock. McDonald's is pretty notorious for doing that. They have a very, what I would consider an aggressive stock buyback program. Okay? Not to be confused with treasury bonds, of course.
As a curiosity, why would they have an investment in
Well, what's the motivation for repurchasing your own stock in the first place? Oh, that's a good question.
Increase stock value?
Yeah, this is one of those CFO decisions, in addition to dividend policy. Okay? This is a CFO decision. Why would you buy back your own stock?
Undervalued.
Okay, one reason.
It's a way to reward the shareholders that issue a dividend.
Yeah, okay. So one reason is if the company thinks that the stock is undervalued. Okay. Well, we have a problem here. Because does anybody walking the face of the earth really know what McDonald's is worth? No. No. Nobody knows for a fact what McDonald's is worth, and we can sell this argument very easily. Intrinsic value, present value of the future cash flows, right? What are the future cash flows going to be? And when are you going to receive them? And what's the appropriate discount rate to use in that calculation?
And how much is somebody using it?
Well, that's fair market value. Okay, so that's something a little different. But if we're talking about what the real value of McDonald's is, we don't know. Okay, so it's just an estimate, and all these financial statements are just an estimate of reality. Therein lies earnings management problem. Okay, so nobody really knows for a fact, but of everybody walking the face of the earth, who is the best to estimate? Who is arguably the best? And don't say Jim Cramer.
CFO.
Don't say Cramer.
The insider.
The insiders. The insiders. So if we see them buying their own stock, then an interpretation of that is that sending a signal that they think that their stock is undervalued. I will be cautious with that McDonald's because they buy back their own stock every year. Okay? But doing it every year is actually is working both demand and the supply side of the price. Because them buying back their own stock is creating demand for the stock, but at the same time, they're taking shares off the market. So it's reducing the supply, which does what prices? That's an upward pressure time.
No, I was just gonna say that that's one of the things that I look at before I buy, but a lot of times, at least with Scottrade, they actually give the reason for the repurchase. Like, it'll say, that he's entitled to such and such, or he's vested now, this person has been vested, or whatever. And it'll actually say why they're buying it in the insider's tab.
Well, yeah, what you're talking about is
It's insider
insiders
trading.
insiders buying and selling stock of McDonald's.
No, I'm talking about the actual employees as far as executives and stuff.
Yeah, but that's not going to be in the treasury stock.
Oh, right,
That's not going to be
yeah.
accounted for, right? And you're correct about what you're saying,
Right.
but that's not going to be the company buying back its own stock.
Right.
That's employees doing their thing.
Right.
Okay. Yeah, and if they're insiders, they have to disclose. You
Why?
guys
Their
know all
stock
that.
is $13
Okay, another reason
from
is,
2009.
what did you
Today's
say?
98 bucks.
To reward their, shareholders without paying a dividend, it pushes the stock price up. But you're not issuing a dividend, so you have to really, so you don't pay dividend back.
Well, yeah, there's a tax issue here, okay? So in addition to the upward pressure on prices, buying back their own stock is another way to distribute money to shareholders, okay? And there's a couple of tax issues here. And this is a general statement, if any of you actually get a master's in tax, you'll talk about this quite a bit, or go into taxation. This is a very general 101 conversation, but generally, if McDonald's pays you a cash dividend this year, then number one, you pay tax on it this year, whether you like it or not. Okay. Number two, you're gonna pay tax on it at your marginal tax rate, your highest tax rate, whether you like it or not. And you may not like it. Okay. But by offering to repurchase your shares, tax is triggered when you sell the shares. So if you don't want to pay tax on it this year, then don't sell them this year. Wait till next year. Okay. In addition, even if you do sell them this year, and I'm a little rusty on my capital gains taxation laws because they've changed a little bit, but traditionally, capital gains are taxed at favorable rates.
15%. Unless you earn over a certain amount, or make over a certain, it just went up to 20, but it's like 200.
Yeah, and those laws have changed.
Going up, right?
Yeah, that's what I hear, that they're going up, but that would, one of the reasons that they're so low, is to provide incentive for people to invest in businesses, which sparks the economy. Okay, that's why they're there in the first place.
It only
So-
goes up for higher earners.
Yeah,
I mean,
so-
just higher people that earn on the actual trading.
Right. Again, 101 conversation, the general idea is that capital gains are taxed at a favorable rate to ordinary income, which is what your dividends are. In other words, if you sell your stock, you can pay lower tax rate on it. Very generally speaking. Okay, so we have a tax issue with this as well, which would be attractive for higher income taxpayers, if you're in 10% taxpayer. Because I think it only kicks in after 15%, yeah. So lower income taxpayers probably won't care too much, except they will care because it depends on when they get taxed on it. Okay? All right. And that's another CFO decision. Should we start the repurchase program? Okay. All right, so questions about any of that? Okay, again, I'm using McDonald's as an example here, but these are basic financial statement accounts. Questions? Okay, let's see if there's anything exciting on the income statement. Okay, so here's your, and by the way, this is a McDonald's annual report that I'm pulling this off of. If you figured that out already. So their consolidated income statement. Make sure, I'm sure you are all on top of this, but in case you're not, get on top of it. Notice the general income statement template. Okay, so we got sales or revenues. All right, they break it down a little bit there. They've actually lumped their operating costs and expenses and all that stuff together, but if we broke it out, what would we have next? Cost of goods sold, which would get us down to
Expensive.
Gross profit.
gross profit. And then we would have operating expenses, which gets us down to operating income. So the cost of goods sold and the operating they put together here, which makes sense because, I mean, if it were a traditional manufacturer, you'd see it broken out. So I don't have a problem with that with McDonald's. Okay, so they got all that together here, bringing them down to operating income. Then, of course, after that, we have basically interest. They also have some non-operating expenses in there, which gets you down to earnings before taxes, and then net income. Being reminded that actually preferred dividends would be on there as well if they had it. Okay, so if you're not on top of this already, be reminded of your general income statement. Okay, and then of course you got your earnings per share, dividend information, and so forth and so on. Again, here's that provision for income taxes. And it's not as simple as saying, well, they've got 2.6 billion, 8 billion, so they're in the 31% or whatever that exactly works out to. It's not that simple. So be careful making that leap of logic. Okay, so questions about the income statement? Yeah.
What are those numbers, the 15.0, 15.9, 14.0?
15.9.
It says interest expense and net of capital.
Oh,
It's right under operating income.
that's capitalized interest. I'd have to go look at exactly what that is.
Okay.
I'd have to go and look at exactly what that is off the top of my head. I don't recall, but.
I think it's the interest that they're capitalizing versus expensing as far as like, the interest on machines and stuff like that. You know.
Yeah.
It has to do with leases.
Well, and that's what
Yeah,
I'm
that's right,
thinking.
yeah.
That's what I'm thinking. I'm not 100% sure, but, which does bring up another good point. It might have to do with capital versus operating leases, remember that stuff? Which brings up another potential accounting issue, okay? You got McDonald's and Wendy's that has the same equipment. McDonald's has financed it via a capital lease. Wendy's has financed it via an operating lease. What's the big picture difference gonna be? I'm not interested in the details, because I don't recall all the details myself, but what's the big picture difference gonna be?
Be more expense on the operating lease versus the capital lease, because the capital lease is asset.
I would agree that it would probably work out that way. That's one of the criteria. Yeah.
So an operating lease is expense, right, like a capitalized lease is capitalized, and then over the life of the lease.
Okay, yeah, if it's a capitalized lease, they're gonna record an asset and a liability. So now your balance sheet has been brought up, because they have that on there. If it's an operating lease, it's not gonna be on the balance sheet, it's just gonna be an expense, just like rent expense on your office. Which makes your financial statements look different. Okay? And an operating lease would be an example of building up the drama. That would be an example of off-balance sheet financing.
Oh,
You hear a lot about that occasionally. You know, people get wound up on off-balance sheet financing stuff. Okay, which I agree with. Okay. An operating lease would be an example of off-balance sheet financing. Because you still have use of the asset, you're still liable for the payments, but there's no asset recorded on the balance sheet, and there's no liability recorded on the balance sheet. Okay? Off-balance sheet financing. Okay. Okay, anything else interesting on here? Yeah.